Hello and welcome to FidelityConnects. I'm Pamela Ritchie. With a consecutive stretch of weekly equity wins through last week, not seen in decades, the case for stocks appears bright bullish green. Tails in the markets catering to both inflation and earnings are pretty clear and present. So today's discussion of how realistic the case for a secular bull market continuation is front and center. This secular bull arose out of the ashes of the GFC and continues to power returns. The road to how we got here is a journey to be unpacked in order to establish the odds for continuation. Joining us here today to cycle you through that journey is Fidelity's Director of Global Macro, Jurrien Timmer. Warm welcome to you, Jurrien. Great to see you, and thank you for your work here today.
Yes, good morning.
Great to have you here. Everyone can send questions in over the next half hour or so. So let's take a look at a very powerful last few weeks, but really a very powerful last several years that you're taking a look at, and how we should be thinking about the cycle and the cyclical. Where do you want to begin with that?
Yes, where do we begin? Let's first just start what we've been doing lately is just put up slide one, which is the heat map. But it's interesting because I'm about to hit the road on an Asia roadshow for our international sister organization, Fidelity International, which of course Fidelity Canada is part of. Mm-hmm. And so I'm going to be there 3 weeks through all kinds of countries, meeting with central banks and sovereign wealth funds. And so I'm mentioning this because I wanted to have a slide deck that is going to be somewhat evergreen, and that's going to be high level, that CIOs of central bank or of pension funds will want to think about. So I spent even more time this weekend going through my entire library of charts, and that's where this kind of the note on secular trends emerged from. But so we'll get there. But if you're possibly able to read this, you can tell that things are pretty calm actually in the market. It's the same fundamental drivers that have been driving this train. Is earnings expectations. They're now growing at 20%. Margins are up near 16%. Credit spreads are down at 72 basis points. Those three things alone explain almost everything you need to know about the market in terms of the valuation, the trend line. The cyclical bull market is now, we go to slide 2, is now 45 months old. And you can see that it's now good for a 118% gain over 45 months. So that's certainly very impressive.
Is it the most impressive of sort of cycle? It is very impressive.
It's not the most impressive. And actually, hold on, I messed up with my slides over here. So I'm going to go back in here and see if this makes a difference. Yes, okay. If we go to the next slide, I have to remember not to move slides around after I sent them to you. So if we move the next slide, we can see all the cycles since 1960 on top. So 118% over 45 months is very similar to the last one, actually. And it's very similar, although shy of the one that started in October of 98 and ended in March of 2000. And you can see, if you look at the bottom in terms of the concentration risk, a lot of similarities there. So it does raise the question of, how is this market cycle going to end? But more importantly, where are we on the secular wave, and how and when is that going to end? If it ever does, maybe it doesn't. So that's kind of where I spend a lot of time pondering over the weekend, and I downloaded it all in the war report yesterday. So we can certainly discuss that.
Let's begin a little bit with comparing, as you mentioned there, the different types of cyclical runs that have been here, bullish runs, but I wonder if you can take us to where you think the secular market has begun, because not everyone agrees on that one.
No, they don't. And we can pull up slide 17. And I'll just say, secular bull markets are like super cycles, right? They are extra long waves spanning usually up to 20 years or so of above average returns. And secular bear markets are interspersed in between the bull markets. they tend to be around 10, 15 years, and they produce below average or even negative returns. And by definition, because these are so long, we only have a few of them, right? So in my sense, we had one in the 20s, one in the 50s and 60s, one in the 80s and 90s, and one now since '09. And I'm kind of a minority among chartists or technical analysts, because in my sense, the current bull market started in '09, and the consensus among technical analysts is that it started in 2013, because in 2013, we took out the high from '07 and 2000. So that was a lost decade, the 2000s. And once we made a new high in 13, a lot of people think, okay, that declares a new secular bull. And I don't necessarily disagree with that, but for me, that point was the point where a bull market was confirmed. But to me, it started in '09. And the reason I come to that is from a variety of different disciplines, obviously just trend lines and things like that, but also valuation, deviations from trend, the CAPE model, et cetera. So in this chart, I'm showing the 10-year CAGR of the real S&P, and I think it's worth looking at inflation-adjusted numbers instead of nominal.
Okay.
And I have the deviation from a 150-year trend line, and you can see that 1929 pops out, 1949, 1982, and 2009. And so to me, those were the beginnings. And if we go to the next slide of the same chart, but showing different valuation measures, and again, you see the same thing, 49, 82, 2009. And if we then go to slide 19, we have the CAPE model. And the CAPE model just says that the 10-year cyclically adjusted PE has, it has very little predictive power over the short term, but it has very good predictive power over the following 10 years. And so there you see that we've been following the CAPE model very well. And those other two periods, 82 to 2000, 49 to 68, all follow that well. So again, there's no right or wrong. It's more art than science. Sample size is tiny, but my sense is I feel pretty good that this started in '09, just like the 82, and there's always going to be catalysts, right? So 82 was, of course, inflation getting broken by Paul Volcker, and then launching, a big prosperity era of declining inflation and declining interest rates. The early 50s, of course, was after the war, after the Depression, a great new, boom time. The baby boom was there. Of course, 21 to 29 was just, the new, the roaring 20s that ended up with a bubble. But what's interesting is that when you look at the tops, 29, 68, 2000, and then at some point, maybe in the next few years, it shows you that secular bull markets will die from valuation, either because the valuation went to bubble-like levels, as it did in 2029, or they're not at bubble levels, but they get eroded by inflation, which of course happened in the late 60s with the guns and butter era. And then, of course, we had the great inflation in the 70s. And what's interesting about all of that is we're looking at the markets now, and we've been talking about this for months, basically, Absolutely. That we have these two tails, right? We have the right tail of a massive AI boom that is just causing earnings to explode higher, margins to get higher, and the market's just on fire because of that. And, it makes you wonder, will that boom turn into a bubble? And if we look at, slide 7, you can see, I don't think we're in a bubble yet, and maybe we never will be, but you look at the non-profitable tech stocks, that's some pretty bullish action. Yeah. And you look at the call put ratios below, like the animal spirits are there. So that's your right tail. And the right tail has pulled us out of this Iran conflict, assuming that it's over. Who knows? Maybe it's not, because the market just can't ignore all those earnings that are coming into the market. But on the other side, we have the left tail, and the left tail is about interest rates and inflation, and that's that brings to mind that late '60s top, and so it could be one of those two tails. One is a bubble that implodes. One is inflation that forces valuations to come down, or who knows? Maybe it can be both at the same time. You never know. I would normally say that's too crazy to contemplate, but these days nothing is too crazy to contemplate.
Well, it's fascinating because, as you say, the AI continuity there has been able to sort of pull us through a very, at least short-term inflationary time. But the AI piece is supposed to make things deflationary. And I guess the question is, can they catch at the right time? There's lots of people that are either banking on that or at least hoping for it. There's no evidence, it appears, at this point to see that will happen with any certainty in the future. Is that fair to say?
Yeah, so that's a great segue to what actually are the hallmarks of this secular bull, right? So let me run through a couple of them, and I'll get to that point as well. But if we go to slide 20, if we are wondering how and when might the secular bull end someday, hopefully not someday soon, I'll be glad to be proven wrong on my time frame. But what are the hallmarks of it? And of course, one, we all know this, of course, is the mega cap growth super cycle. You look at the top 50 stocks are now 60% of the market. The FANGs, now the Mag 7. We'll have to call it something else once SpaceX and Anthropic and OpenAI join. It'll be like it'll be the $1 trillion club or whatever, the trillion 10 or something like that. But the market's about to get even more concentrated once those IPOs launch. And I do have a couple of slides on that. But if we go to the next slide, obviously we have to start with earnings and margins, because if you look at the bottom panel, it's the PE ratio and the operating margin for the S&P. Those two move in lockstep, right? And the margin in 2009 was 5%. Today it's 15, 16%, depending on which one you use. I'm using a different one here than what I showed earlier. So clearly the margin story drives the secular bull and supports the valuations, right? I mean, you look at that CAPE ratio, we're near the all-time highs, but again, credit spreads, margins are, they explain a lot of that. And so that will be part of the story as well. Then slide 22, we show capital flows. This is the U.S. exceptionalism, and that has brought a stronger dollar with it. And again, the tariff tantrum a year ago did really nothing to even break that capital flow. Remember, a year ago we were talking about, okay, does this mean we're going to have repatriation of foreign assets? And well, it really hasn't happened. Although you will see on the dollar chart there, we're at an interesting intersection of support and a long-term trend line. And so a weaker dollar is certainly something we've been talking about in this era of, where geopolitics is becoming more transactional and the U.S.'s role in the world stage is maybe changing or eroding. Now, let me get to the good bit here. So if we go to the next slide, 23, we can see financial engineering. And it's something I've been writing about for a long time. I think it's often not really appreciated how big a factor this is, because we know that we're going to get these 3 big IPOs, and we look at this chart, right? So below the horizontal axis is the cumulative IPOs and secondaries since 2009. So 2009 started the financial engineering era. It started, obviously, the QE zero interest rate era, heavy-handed central banks, things like that. But so $3.5 trillion of new issue, and you compare that to the retirement of shares either through M&A or buybacks, and it's about $30 trillion. So there's like almost a 10-to-1 imbalance between the demand for shares from within the corporate sector and the supply of shares. And that, I think, really explains a lot of why the returns have been so outsized, because it's supply and demand, right? But here's where the nuances come in. So if we go to slide 24, you can see that as a percentage of earnings, dividends and buybacks are now losing share, if you will, because CapEx is cannibalizing it, right? Because these companies, the Mag 7,
they can't give it back if they, yeah.
And like investors like Will Danoff would say, well, if you got too much cash, just give it back to us through buybacks, which is exactly what they did. But now they're using the cash on CapEx and there's less cash. So it's at the expense of buybacks. And it's not the end of the world, but buybacks clearly affect valuations. And again, this at the edge is maybe a subtle hint that maybe the financial engineering era is cresting. And then we'll add the IPO side. If we flip over to 28, so this is interesting. So we're going to have SpaceX, OpenAI, Anthropic, and together those it's like $3 or $4 trillion worth of companies. And at first glance, I'm like, oh my God, how is the market ever going to absorb
what's
that?
The absorption, yeah, okay.
Yeah, but so my colleague Pierre said no. That's the actual float coming into the market is about 300 to 400 billion and not 4 trillion. So like Elon can't just sell all his stock, tomorrow. So if you add 300 to 400 trillion, you get to where that star is, and that's a big deal. But it's not like 10 standard deviations from historical norms. So it'll be a big deal. It'll be a lot. But if we go to the next slide, again, still we have to look at IPOs against the demand for shares. And again, where that star is where the IPOs would come. So it would be one of the biggest IPOs events ever. And of course, you look at the two periods there highlighted. One, of course, was 2000. I mean, that is when IPOs come into the system. And the other one was 2021, when we had a little asset bubble coming from all the demand from the fiscal stimulus and then the Fed and other central banks being way too accommodative. So it would be possibly a bell ringing event, but only possibly. And so that's kind of how I think about putting all these things together. But now, so I know you asked about inflation. So let me just go to slide 26 real quick and talk about what the left hill could look like, right? So here's the Bloomberg Commodity Spot Index. So we're all familiar with the BCOM, which is the commodities index, but that one includes all kinds of roll yields because investors will buy products linked to that. But the spot index is just spot prices, oil, gold, copper, have you. And you can see that until recently, the TIPS break even was perfectly aligned with the BCOM SP. And now the commodities are at new highs because of oil. And the TIPS break evens are just sitting there like nothing to see here. And one of these two is going to be wrong. And I don't know which one it's going to be. If the war ends, tomorrow and the Strait of Hormuz opens up, oil will go back to $60, $70, $80, and maybe that the black line comes down and the TIPS break evens will be right. But it's an interesting conundrum because we have other bits of information, right? If we go to slide 25, it looks to me.
Sorry to interrupt, but that doesn't look like that's happened very often at all. That's pretty.
No, it's rare because in 2022, when oil prices spiked, the TIPS break-evens went right with it, as they should. And this time, the bond market is saying, no, this will all be coming back to normal. But, the Fed is now on watch. Expectations are that the Fed will have to raise rates, although that's just a snapshot in time. The 10-year yield did bounce up above 4.5 a few weeks ago, and it immediately had an impact on the stock market. But so here's the super cycle for commodities. That's in a secular bull market. And what's interesting about that is that usually if you look at the 10-year CAGRs at the bottom, usually commodities are the opposite of stocks, which kind of makes sense because commodities are an inflation play, and financial assets do not like inflation, whether it's stocks or bonds. And so they are now apparently both in a secular bull market, which is fairly rare. And so are the commodities telling us giving us an early warning sign that the left tail of higher inflation, higher rates, tighter Fed policy are going to have an impact on valuation, just as the right tail are boosting valuation. And it's a real interesting conundrum to how do we manage a portfolio where you have both tails. I mean, there's always tails lurking, right? But imagine if they both are active at the same time, which they're kind of starting to do. And it's, so maybe that'll be the last, few innings, or maybe that'll be the extra innings for the secular bull. But those are the things I'm watching as to, okay, we know when and how it started. We know what the drivers are, and we know what usually ends them. So let's look at those factors and see where they are in the span of history to see when and how this one might end. And again, hopefully it doesn't end anytime soon, because it's nice to get all that beta because it kind of fast forwards, right? We can over earn the things we need to achieve when we're saving for retirement, or our advisors are helping their clients save for retirement. So
yes.
you want to get those harvests while they're going strong.
There's a great question coming in here. Can you comment, Jurrien, on the widening divergence between CPI and PCE in the U.S.? Is it something? I mean, we're watching inflation pretty closely right now. What do you think of that?
Yeah. So, I mean, they're correlated over time. They have different compositions, of course. The Fed tends to favor the PCE. And, of course, the CPI is an index that never changes. Well, it can change, but it never retroactively changes because, cost of living adjustments are tied to it. So they're just different compositions. But what I think is more interesting is that we tend to look at things ex food and energy because they're volatile. But if we look at the things that are really plaguing people since COVID, it's certainly food, right? I mean, and so we can't really strip those things out anymore, and energy as well. I mean, we're less energy dependent than we used to be, but the things that we tend to exclude are the things that are actually driving this K-shaped, economy these days. And so I don't think we can really exclude them anymore. And there's also not a lot that the Fed can really do about it, right? Are they going to tighten policy because food and energy prices are high? Like these are necessities that people consume, right? These are not luxury cars, and so it's a little bit of a dilemma. But sticky inflation is a real issue, and we can pull up slide 34 for a second, and hopefully whatever we're seeing on the good side of inflation, as you pointed out earlier, can be offset by the AI promise, right? Certainly the promises seem to be compelling, productivity, certainly earnings, efficiencies, hopefully cost reductions come with it so that at least the two can offset each other. And yeah, so here's the inflation, the 5-year inflation rate. This is the CPI in the bottom, and the Fed policy rate. And you can see that the Fed has been easing, of course, even though the 5-year inflation rate has been rising. And so a Fed not only not being able to ease policy any further, but having to be kind of on its back heels to raise rates is not what was on the market's bingo card at the beginning of the year. And it certainly wasn't on Scott Bessent's preferred list or Kevin Warsh. So so it'll be an interesting thing to watch and to see how it affects multiples. But it's a reminder that the Fed model rules when the risk-free rate is competitive with the risky asset, and that's slide 27. Not to bombard you all with so many slides.
No,
but
they're amazing slides.
It shows you. So the bars is the S&P 500 PE. It's at around 22. And the black bars are the Treasury PE, so the inverse of the yield. And you can see that the Fed model doesn't really count when the risk-free rate is not competitive, as has been the case, right? So the bond PE for years has been well above the equity PE. So what happens on the bond market, it matters, but it doesn't matter as much. But once those two yields converge and they're the same, it matters a lot. And that's why 4.5% is like the magic number right now. Not that there's anything special about 4.5. It could be 4, it could be 6, it could be 3, but 4.5 is what the yield is on stocks and what the yield is on bonds, and that's why it matters. So if we go from 4.5 to 5, the equity PE probably comes down 3 or 4 points, and that's how that model works.
It is sort of incredible the competitive nature of the two for investors, when ultimately there's yield on the other side. You take a look. Can you come back to the U.S. exceptionalism story? And I'm just curious, through other secular bull markets, when you go back through, I think even back to the 20s, wasn't U.S. exceptionalism a very large part of that always? When you look as sort of an international, we're talking a lot more about international diversification at this point, but U.S. exceptionalism and that driving the global markets has been around through many secular bull markets, has it not?
Yeah. No, absolutely. We can pull slide 18 up again. But yeah, for sure. So the Roaring 20s, of course, back in the day, I mean, the U.S. was really like, it used to be Britain, right? And then it became the U.S. during during the early part of the last century, right? So the pound collapsed and the U.S. became the dollar standard of the world, and everything was based on the gold standard. And then in the Bretton Woods era, every currency got pegged to the U.S. dollar, and the U.S. dollar was pegged to gold. And then, of course, it became a free floating exchange system. But yeah, the 20s, obviously, the Roaring 20s was U.S. exceptionalism in some sense. The 50s, of course, clearly the U.S. was rebuilding the rest of the world, the Marshall Plan, all that stuff. You had the baby boom, right? I mean, that was really the heyday. You got like the suburbanization of the country, and so the 80s and 90s. I don't know if that was necessarily U.S. exceptionalism, but it was global disinflation. And of course, then in the 2000s, the world really globalized, and now it's becoming multipolarized. So, but certainly the 50s and early 60s and the 20s were periods of U.S. exceptionalism.
Valuation being sort of the key thing that plummets at the end of a secular bull market, which you've mentioned. But valuations look pretty good. I know that we have these tails and we're talking about them, but as you say, you did last week, price between earnings and valuation. I mean, things were looking very steady there and even further out from there. So I guess just walk us through sort of the valuation story. It seems solid.
Yeah, so we pull up slide 12. So valuations right now are steady for the simple reason that earnings are growing so fast, right? I mean, earnings are growing at 20%, which is remarkable. So the market is up, but because earnings are up so much, the valuation side isn't really moving that much. But again, I come back to margins and credit spreads and earnings. I mean, earnings and margins are kind of the same thing. But if you just look at margins and spreads over time and you do a regression against price and against valuation, you will see that they explain most of what's happening. So the top panel is the price index. The bottom panel is the 5-year CAPE ratio. I tend to like 5 over 10 because it encompasses a full cycle. And you can see how the tech bubble stood out because it was not explainable by these fundamentals. It was truly a bubble, right? Bubbles are going to be irrational and they cannot be explained by the fundamentals. And so you compare the tech bubble to now, and they're totally different, right? Right now, you can explain the price action through margins and credit spreads. The only fly in the ointment is if you add then bond yields to them, which is the blue line in both of those panels. Now, all of a sudden, the PE is over its skis. And again, that's the Fed model rearing its ugly head. And that's why my sense is, like, if this thing ever ends, there's going to be a spread between what is fundamentally justified and where the actual market is trading. And it could be a bubble where the PEs just go to levels that are not rational, like what happened in the tech bubble. or it can be like what happened in the 60s and 70s, where it was higher rates and higher inflation that pulled down the valuation, even though earnings are fine. And those are the two kind of tales that I look at as we sort of ponder the final innings here.
We've got quite a lot of info out this week, economic data. Friday really is the big one, the jobs report. You're looking higher level, longer term. Is there something in this week that you want to just point out to investors as we close?
Well, we're looking, of course, for hints that the AI boom is not creating a jobless expansion. And so far, there's really no evidence that it is, right? The jobs numbers have been stronger lately. But you're looking for little signs of that. And you're looking for, of course, for wages. We know that prices are up about 30% since 2020. And so we want to get a sense of that inflation. If inflation is sticky, are wages at least holding on? And so those will be the things that I look for.
Okay. Jurrien Timmer, thank you for sharing with us what you're about to go to Asia and share with very high-level pension managers and so on. So we're delighted, as always, to have you, and thank you for sharing your knowledge.
Well, thank you very much.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.